So let's begin. Hi guys. Today I want to talk about this time frame, specifically on regular trading hours. This is something that we are using with a friend of mine, Lucas, and he told me about the importance of this time frame. Why? Because it's basically your daily chart for regular trading hours. If you try to change the time frame above this 7 hours chart, for example 8 hours is the same, 10 hours is the same, 12 hours is the same, 7 hours, but if you move below 7 hours you are not going to see the full daily candle. Why? Because on regular trading hours, if we measure the daily range, the daily time, we have let's see in 1 minute, from here, the 9:30 opening to the close, we have 6 hours and 44 minutes for the daily range on regular trading hours. Okay, so basically 7 hours is the daily candle for regular trading hours. And why it's important? Because you can see here things that you can't see on electronic trading hours or charts. Obviously this chart requires like a different kind of experience to really learn to read this chart, because it's not the same. You can see, for example, on this day, this is a clear example, the space between these two daily candles, this is a BC. This is a BC right here. But for example, the space between this candle and this is not a CV. This is a liquidity void. This is different. And you can use this as a breakaway gap and project this gap to anticipate key levels for support or resistance on the future. But why it's important? Because, for example, obviously after I want to talk about this. This is a new week opening gap indicator, but because we are on regular trading hours, it will plot your Monday gap for every week. Why it's important, this specific gap for the weekly range? I used to use the new week opening gap on electronic trading hours, and I think it's valid, it's really good. We should have two templates, one for this chart and another for the electronic trading chart, but being honest, I prefer this chart for me. So if you think this is where we change price delivery on previous week. This is a new week opening gap. We close below this gap and we use it as an area as reaccumulation to take the liquidity below this new week opening gap on regular trading hours. So where is the liquidity? Here, below all lows, and here. Okay, I will use this because we have here 2 weeks, 2 gaps from this opening, and this is a low. So below this is resting a lot of sell stops for 2 weeks. And now when we close below this gap, we are targeting at least this area as fair value, these gaps, on or and these sell stops right here. So this is important. Look the price action between these two daily candles on regular trading hours. We close here with a bearish candle, and we open inside of this range, but we close below. So the price action between this low and this high is balanced. We close below, high, lower. There is no reason to come back above this level. This is protected for the algorithm because all this price action has been balanced. And we have here these new week opening gaps holding price. Look how we didn't close above this line, these gaps. So this is important for today's price action, for the previous day's price action. We take this high and we activate these buy stops resting above this high, and we move lower to take the liquidity resting below this low because it's below this new week opening gap on regular trading hours. So this is important. So if you note this from this close to this open, this price action here, let's see what we have here in lower time frames. Okay, I will change this to the 15-minute chart, same on regular trading hours. And what is this? Look, what is this? This is the opening range gap from Thursday previous week. Do you see how we use this as a balanced price range? After we close below, we retrace, but we respect the 50%, the consequent encroachment of this level. There is no reason to come back above this high because this price, this range is balanced. And you can see that on the daily chart, on 7-hour chart here. And look, for example, an electronic trading hours chart. Most of the traders were trying to reprice this. Obviously, we had an SMT with ES here, but there was no reason to come back above this gap to this inefficiency right here, because on your regular trading hours daily chart, the 7-hour chart, we saw that this price was already balanced right here, and we come back to the 50% of this price action, activating these buy stops and moving aggressively to these specific levels. That is where the real liquidity is resting. Why? This is not something that I am trying to like something new or esoteric concept about this, because we are trading a stock market index. What does it mean? Because the New York Stock Exchange are only open for 9:30 New York to 4 p.m. So the liquidity above or below these highs is where the institutions are placing their stops, basically. So everything on your electronic trade chart on overnight hours, you can place a stock trade outside of these times that I'm telling you. So the real liquidity is above or below these levels on this chart. Okay, so yes, let's shut down here. Look, this is the breakaway gap that I told you. This is the liquidity point, because there was no between this level, this low, and this high, there is no candles at all. This is a true liquidity point, this price action right here. Okay, so today I was expecting a little bit of more like touch this lower quadrant of this range of this, because this is a breaker on regular trading hours. We take these highs and we close below this low, but look, we come back to specifically to the low only. Literally we open, touch the low of just of a Friday price action, and price melt down to these levels. So yes, this is how I see these moves. So I was looking as a draw of liquidity. You saw on my Twitter that I was posting that I was looking this as a new wick opening gap and the liquidity below this. Okay, so look how we were looking for these levels, and something that I use also is these standard deviations from these gaps. This is very important because you are not measuring like some random swings and lows. You are measuring time-based gaps, and because the algorithm nature of price, this is really important price levels for the daily range. So look, the standard deviation automatically from this gap here, we have 3 standard deviations aligned with this gap, and we have 1.5 standard deviations from today's regular trading hours gap, and we have the sell stops from these days, this week, because this is a week, new week opening gap. This below this is liquidity. So I was expecting that after taking this low, a short rally into the 50% of this last dealing range, and was tapped to the tick, this level here, 50%. Okay, so look, let's move on to the 1 minute chart. Forget about electronic trading hours right now. So this is the price action, the low of the previous Friday here. We gap higher, take this liquidity, come back to the gap, accumulate more longs at the 50% of the gap, and distribute the orders above these old highs. Then we come back again to the 50% of this balanced price range that I show you, and there is something very important of this price action, but I'm not going to talk about this today. We open lower. This is a huge gap, and I told you I was expecting like a little bit more of retracement, but this is something that it's hard to anticipate on these days. Okay, so we just touch to the tick the previous level I told you and come back and start to moving lower. So obviously you can look for imbalance around these the macros. For example, we have the 950 10 10 macro, and we were inside this imbalance, this little VC right here. So I didn't take this trade because I was expecting another kind of a scenario, and it was hard for me to trust in this move, and so I wait to this setup here. But you can short this. Obviously it requires like a little bit more of experience and confidence and just risk management. If you place your stop loss above this candle here, it's fine. But I didn't take this trade. My fault. The trade I took was this, the short around here, because I was looking for these levels here, and this is the PM session start. Here is a 1:30 opening, and this is the launch time interval here. So this is a range, like a little bit of or like consolidation with retracement, and I was looking for shorts. So if you move on to the 15 minutes chart, you will see that there is an imbalance right here. Right here. So this is the liquidity resting for the launch lows here, and you have here this 15 minutes imbalance right here. So I like to wait when I'm expecting like a retracement like this. I prefer to wait when we have like a change of the state of delivery of price on this side. I don't like to just short like on this PDRA. I like to wait to see if we run these highs, because you really don't know. But once I saw that we create this order block at the 50% and we close below the open of this candle, this is a change on the state of delivery. I took this short right here. And then all the bullish PDRAs created should act as an inversion PDRA. So I took another position right here. When we touch this is another entry right here, another entry, and I start to take partials below all lows. Partials here and partial here and partial here. The full take profit here. This is how I take trades on the PM session. This is a classic launch rate, the liquidity from launch, and you wait from the PM session to start the price delivery. And look, this is another trade I took at the PM session, at the power hour, to show you something. Okay, if you measure this price swing, and we took the liquidity below the weekly new week opening gap that I show you, smart money are going to offset their shorts from all the day below this high time frame level and below short-term lows on lower time frame. This is really sauce right here, guys. This is how you trade total subs. This is an area below this swing here where smart money is going to accumulate longs, or not accumulation because we are in a short program, but they are going to like unload the trades. Okay, so I took the 4 standard deviation of these levels as an entry level, and 20 points or 15 points above this level as a stop loss. You measure here 20 points. This is your stop loss area. This was my stop loss area here. And I closed the trade at the 50% of this gap. But we took the liquidity on this little consolidation right here. And look the macros from the PMs, from the power hour. After this, we close aggressively, and this is the daily close. You see? So this is how I trade. Basically, I frame my trade ideas on a little short time periods of the day, on little time windows, but the logic is it's coming from regular trading hours. So look, for example, this standard deviation, this 0.5 standard deviation from today's gap, and this is like the 9, 50, 10, 10 macro we create. But this price action is, I really don't like to trade like these candles with this kind of wicks. It's hard because I don't like it at all. But you have here, and this is also look, we leave this wick here. I don't like this. I prefer clean bodies, in respect. But this is something that you can study by yourself. So yes, now that we reach these levels, I'm not expecting like these kind of moves again, like this big, because now we are inside of this breaker. Okay, we took this short-term low here, and we close above it, come back, touch it again, and expand higher aggressively to this. So now we have here this breaker that should provide like a counter move to this bearish trend, but I don't know if we are going to change the completely bias for longs, but we can use the standard deviations. Now we are of these daily candles 7-hour range, we are trading on this retracement area here. And also if we project the standard deviation of the gaps here, this close to this open, we are also trading at the 2 and 2.5 standard deviations of this gap. Is this on regular trading hours here. You see, is close, open, and is this gap. Sorry, this this is the open, the close and open. And so we have now this standard deviation of this breakaway gap and this projection of this move that was the last this is like the order, the move that provide the change of the price delivery right here with the new weeks opening gap. But yes, I think that this chart is really important to see every day, and also the logic that I told you, that how you can use these gaps on these candles to anticipate this kind of when we are going to hold this gap open and on where we're not. Now, for example, look how this price action, this is something interesting. We move after we taking this low here. We close below, but we retrace to this range, right? And we gap to this low. So everything, you can see that you think this is a volume imbalance or a liquidity void here, but not really, not at all, because this price action was trading just a bit below, upside again, and we close below and we touch the low and we leave this price action open. This is something for your studies. This is open. So maybe if we are going to come back to after, or maybe we can just take this, make this this could be a scenario. We can take this low again and touch this volume, this gap here, and this breaker, the 50%. Look for a shift on a structure on 15-minute chart with displacement maybe, and retest and move higher to this range that is open. And we have also this gap. This is something that could happen. This is not financial advice, obviously, and I'm not telling you that this is going to happen, but this is scenarios that could happen right now because on the price levels that we are trading. Okay, so study this video on price action on this chart, note these price levels, and look for lower time frames and reactions or trades. Okay, stay safe, guys. This is everything for today.